Good morning, good afternoon, or good evening, depending where you are on the planet. Welcome to today's Bull versus Bear webinar. Steve Marty on the call here as ever for Trade Day. Hope you've enjoyed having Richard on this week as well. Today's Thursday, the 27th of July, and this is today's meeting. So welcome, everyone. We're going to go through our usual regular run through in here today. A couple of little bits of actually housekeeping, really. So, yes, we know there have been issues with Trade Debate. It's the elephant in the room a little bit. Obviously, clearly, I think, as you can appreciate, way beyond our control. On the upside, James has put a long post in here about the issues that we're facing. We have a meeting tomorrow with Trade of 8 / Ninja's senior leadership team, and including their senior technical team. And their liaison team with the various prop companies. So we're speaking to them. This is not an issue that Trade Day is facing alone. We know that our competitors are facing it as well. Top Step are seeing it. Apex are seeing it. It's not just us, guys, right? So it is beyond our control. We are on to Trade of 8. Trade of 8 are very aware of it. They did think they'd solved the issue. They clearly haven't solved the issue. The lag issue continues. Occasionally, there's not much we can do about it right now. You could trade via Ninja. You could trade via. Sorry, I'm losing my train of thought. In Ninja, you could trade by TradingView, right? However, it doesn't necessarily. Everything still gets routed through Tradeovate. Okay, so it may not circumvent the issue, right? So. Maybe it will, maybe it won't. Unfortunately, it is part of trading. I'm not making excuses. I appreciate, I've been in real live markets, I've been on the wrong side and lost, very large sums, believe me, very large sums because of being on the wrong side of technology issues that have not been at my end, that have been at the broker's end. The broker always has his get out of jail free card. They always say, they're not going to, they don't take responsibility for that, so we will be speaking to them. We will hopefully give an update tomorrow once we have spoken to Trade of 8 / Ninja Trader tomorrow. We are getting updates regularly. We thought the problem was solved. I know it's a pain. I know it's a pain in the butt. It's a pain for us. It's a pain for you. There is little we can do about it right now, unfortunately. Where we know have been issues, we do try to offer resets. However, the nature of this business is that there's a lot of people, that you guys may be honest, who are I don't know, right? But we have a lot of people just claiming that they have issues because they're trading badly and they claiming there are issues. We have a lot of people make stuff up, right? You wouldn't believe the amount of stuff that goes on behind the scenes, chargebacks, people making up stuff, saying they didn't put orders in when they did put orders in. My dog hit the keyboard and all this kind of nonsense. We have all sorts of stuff to deal with, guys. Okay, so I'm not pointing any fingers to anyone who's on this webinar, or listening to the webinar, but I'm just saying it's difficult. We are getting to it. There have been a number of issues. We are aware of it. We are trying to deal with it. It's our business. We appreciate this. We know we've been trading for 30 years each with it, but in the markets, this is not ideal, and we will get a problem. We will get the issue sorted. The issue will get sorted over in the hopefully not too distant future. And we'll update you as soon as we know. Okay, that's the boring stuff done. Let's talk about the market. So let's look back first of all. And obviously it was Fed day. Market, the Fed delivered as expected, the 25 basis point rate hike. No surprises there. But what we did see in here was, even though Powell left the door open for another hike in September, he did do that, right? And that's kind of reflected if we jump to the CME tool. This has gone up, September hike now, only a 20% chance, by year end. This is probably slightly lower. We're expecting 28, 29. It's almost the same though. We've been sitting around 30%. For the rates to be up one more time by the end of the year. A little bit of a chance of a rate cut as well. So, but these numbers haven't really changed much since yesterday. Let me just check on this one in here actually, the 550 to 575 on historical, where it was compared to yesterday. So let's go take a look compared to pre. So this is on historical, you can see. Let me just move this up a little bit. 550 to 575. Yeah, so it's actually dipped very slightly lower. So we were up to something like 85% chance in here. and now so we've dipped a little bit lower in here. The potential for a September another rate hike in here. So have I got the right thing there? Hold on a sec. 550 to 575 in here. What's the chances of us being at 550, 575 historical? That seems wrong, right? That's not right. 80.85. Why is it showing 80.85? Is that right? 550 to 575. 575 to 600. No, this is it here, right? I think this is not updated correctly, but this is it. So it's pretty much been sitting around here anyway, right? So the chances haven't changed too much in here from where we were yesterday, to be quite honest. The chances of another rate hike going into the end of the year, but the market is kind of taking it fairly positively. So even though he's left the door open to a September hike for the next meeting, the Fed staff did drop their US recession forecast. Okay, so that's a positive. The Fed staff are now not looking for a recession. And then global stocks higher, view that Fed rates have peaked, so even though we haven't any kind of real change in that CME tool, it's, the positivity. There is a kind of a relief that there wasn't a more hawkish tone. I said yesterday, I think if they delivered and they were just fairly dovish, just where we expected them to be. The risk was they were more hawkish, right? The risk was like, okay, we might need to hike again, but they certainly backed away from that, and opening the door to potentially leaving the door open that they may need to hike. But if the data continues to move in the right direction, which it has been more lately, then they won't likely hike again. There's likely more likely on pause, and the markets have told us that, right? So global stocks are obviously up this morning. I'll come to that shortly. The US dollar going down. As Fed says, next interest rate move will be data dependent, and obviously the market reads to that. Well, the data is pointing in the right way. Question for William: is there a reliable ECB equivalent of the Fed Watch tool? Not that I'm aware of, William. You can go and have an actual look at the Euribor curve, which is the equivalent to what the Fed Watch tool. So this Fed Watch tool is based on the euro dollar curve, right? So the short end interest rate, or the Fed funds rate. Okay, there you can go and actually look at the curve itself, the actual futures, where the futures are trading on the European short end. So, but that's not going to really help, I don't think. So it's traded on Eurex, Euribor. This would be the equivalent in here. Okay, but as far as I'm aware, there isn't. Yeah, I mean, you can go and look at the individual markets, okay, but you can't actually take a look at the. So you can go and look at the actual quotes on the actual individual markets, for the different months in here. Okay, but you can't actually then get they don't pull it all into one easy viewable tool. Unfortunately, be nice, right? If I come across it, I'll let you guys know. But I've never seen it before. I've never seen anyone else use it either. So we are obviously then ECB. That will bring me to ECB in a minute. So the market certainly reacted in a risk-on way. The dollar's down, stocks are up, oil is up as well. Where is that? Oil resumes rally as equities gain. US inventories decline, so that's obviously had an impact as well. Supply cuts by OPEC have aided recent increases in futures. Well, they have, but also this risk-on move that we've seen reasserting itself more recently. The fact that we are seeing a positive, potentially a pause from the Fed, a longer pause from the Fed going forward. After we had the pause and then a hike, looking for a pause and a longer pause, an indefinite pause, maybe that we're at rate peaks, and similarly looking from the ECB today potentially as well. So that does bring me to today's data. So we have the ECB in 35 minutes time. And then after that, you get the press conference at 8:45 Eastern time. Okay. In between that, though, we do get US GDP, durable goods data. GDP is okay. It's fairly significant. Usually I'm a bit skeptical with GDP because usually it's very, very backward looking. And this is still fairly backward looking. But it's the preliminary data for Q2. So it's the first time we get a look at the Q2, the quarter-on-quarter data for Q2. And Q2 was only a month ago, so it's not miles and miles ago. So yeah, I mean, I think we can see in there we might see some price movement, also get durable goods orders as well coming through. Initial jobless claims isn't usually a big market mover, and then we then move on and we also get the ECB press conference. Probably more important to be looking at the press conference than we're very much expecting a rate hike of 25 basis points, the same as we had from the Fed yesterday, but the press conference probably more significant. And really, I think they're walking a bit of a tightrope at the moment. It's very difficult to give that forward guidance. I think that's the hardest thing for them going into today's, the guidance they kind of give. So it'd be interesting to see what they do come up with in here on the guidance side, because there is an anticipation that they may go on pause. They probably don't want to indicate that. They don't want to go anywhere near as close to the Fed as indicating that they may go on pause, because the actual European data has not been particularly great in here. The European inflation data has not been, it's of late, overall it's not too bad, but of late the more recent data has not been great. So they may be walking a bit of a tightrope. So it'd be interesting to see what Lagarde has to say. Question from Stefano. A question on the oil market: is it usually affected directly by central banks' rate decisions, or is it affected indirectly through other markets, for example the S&P? So oil is a real complex one, Stefano. It's one market that I've never wanted to trade. I've never actually traded in to any extent. I've covered it purely from a technical analysis basis. It is an odd one because it has so many factors. So if I can list some of those factors out, right, it generally acts like risk on, risk off. What do I mean by risk on, risk off? Risk on is traders willing to take more risk. Risk off, traders willing to take less risk. So if we see the global economy doing well, so if you see central banks, being less hawkish, like we had yesterday from the Fed, central banks less hawkish, right, means then interest rates potentially not as high or lower than we've previously expected. And then that stimulates the global economy. And if you stimulate the global economy, obviously there's going to be more demand for oil. The better the global economy, basically, and it's not just a one country's economy; it's the global economy for oil, right? The better the global economy, the more significant the more positive, the more demand there is for oil, and then the oil price goes up. And the opposite is true. So if a more hawkish tone from central banks or a more negative outlook for the global economy tends to see lower oil. There's also a fairly big correlation as well. And it's, when we say global economy, a lot of time we're looking at maybe with a lot of eyes on the US because it's the biggest economy on the planet. But then we also have a big significant impact from China. China uses a lot of oil. It imports a lot of oil. US is self-sufficient on oil, so it's less impacted by demand and supply shocks because it's got enough oil for itself. So, but China imports a lot of oil. So if China is doing well, and at the moment, obviously China's not doing, a lot of the negative price action we've seen in oil over the last few months in here is because that negative the negative outlook for the Chinese economy and the fact that China's not been stimulated. But we have seen some stimulus indicated from the Chinese economy. So you're looking here and here. So I think it does talk about, no, it doesn't actually mention it in this one. But the fact is we've got some stimulus potentially coming through from China. There's been more and more indication of stimulus for the Chinese economy out of China, and that's positive for oil. So we're looking at, anything that's positive for the bigger picture global economy is usually positive for oil. Then you've got the whole supply side. We're looking at the EIA and also the API data in here. So if we go back to the data in here today, what day is it? Thursday. So we should have the, don't know if they always have it on here. So we have, no, so it's Tuesday and Wednesday, Wednesday, Thursday. We have the EIA. EIA was yesterday. API data, I think, is Tuesdays. The oil traders should be able to tell me that. We have the restriction on the EIA data, for oil trading. So there's lots of factors. The dollar as well is a factor. A weak dollar, so oil is obviously quoted in dollars, yeah. So most commodities, if you see a weakening of dollar, the commodity price tends to go up, and a strong dollar equals the commodity price goes down. So that can have another impact. And obviously then the dollar is reacting to the central banks, and the dollar is reacting to, so clearly the dollar down in here, we've seen the dollar go down over the last 24 hours again. Okay, the dollar's been mostly selling off, but the dollar going down a lot in here, and the dollar going down in here because the Fed is less hawkish, so you don't want to own dollars, okay, and you don't want to own dollars as a safe haven. You don't want to own dollars because maybe the interest rates are not going up as much. So you don't want to own US dollars, so the dollar goes down, and that's also helps oil. So there's lots of aspects to oil. It's a fairly complex market, and then there's just natural supply and demand within the oil market as well, and obviously there's a lot of control in that, particularly on the supply side from OPEC plus. Hope that answers the question. It doesn't actually give you a direct answer, but there you go. So Stefano from John. Okay, there you go. Let's connect. I've been trading since I got funded. Not many old traders out there yet. So yeah, do connect, guys. Feel free to share your email addresses in here if you want. Whatever you want to do, it's up to you guys. Or via the forums, whatever you want to do. Let's get back in here. So yeah, so basically we've moved back into risk on phase really, and we can see that on the overnight activity in here. There was also that China tech stocks on brink of bull market on stimulus hopes. So ongoing stimulus hopes as well, helping China tech on the verge of a bull market. So that's going to be 20% off the low. So here we have, look, the Hang Seng Tech Index was up 2.9, extending gains from the May low to 19.7% up in here. So that's a positive as well in here. So that's helped the market higher this morning. And if we looked at what we've seen overnight in here, Hang Seng's up 1.4%, Nikkei up 0.7% on the back of that kind of hopes around the Fed going on pause. The UK FTSE is not much, pretty much unchanged, only slightly higher, but you've got the DAX and the CAC, the German, the French indices up nearly 1% and just over and 1.33% in here for the CAC. And if we look at the US futures in here this morning, Nasdaq leaping high, 1.25% up in here. Not much change in the Dow, up over 0.6 in here for the S&P overnight. So strong movements in here overnight. So looking ahead today, as I said in here, we do have the ECB. When this loads, hopefully those will go here to the Bloomberg. ECB to hike rates again with finish line in view. So we are looking at up to 3.75. A lot of signals on September meeting focus, but likely to be scarce. So we're not necessarily expecting any strong guidance on which way they're going to go at the next meeting. Their next meeting is again in September, but they're probably going to be fairly vague in here. Look, communication be the ECB's key challenge. Okay, policymakers want to remain flexible, retain maximum flexibility by not sending too decisive a signal in either direction. They are really poised. That's that tightrope. Look, EC officials see communication as the toughest challenge in July. So it's not actually whether they hike or not. That's pretty much built in. It's like, how do they communicate that they might go up, they might go down, they might stay where they are. They're unlikely to go down. The guidance to probably underline next meeting hinge on data. Yeah, so that's what we're expecting. We're expecting them to say similar to the Fed. We're watching the data. We're going to watch the data. So that's what we're probably expecting in here today. Nothing too hawkish, nothing too dovish from the ECB. Right, what haven't I covered in here? Oh, the other thing of note from yesterday then was, if I go back to yesterday on the earnings side, so we had Meta. Meta did really, 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 really well. Okay, not only on the numbers in here, but also on the guidance. So beat on both revenue and earnings per share. And if I go to my Meta articles up here, so Meta on track to hit levels last seen before the historic crash nearly 18 months after setting the record for the biggest market value wipeout. So there was that big drop. Do you remember when they lost, 251 billion in a single day in here? As it flags slowing revenue growth, it's getting back up to those levels. So a positive Meta rallies as AI-powered ad sales drive monster forecasts. So positive guidance from Meta in here. All very, 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 very positive in here at the moment. So that's helping. That's helped. That's really a big part of this leap we've seen this morning in the Nasdaq, up 1.25% in here on the back of the previous positivity we had out of Google earlier this week, even though we had the more negative outlook from Microsoft. Going into today, it's much lighter on the calendar in here. Intel's probably the standout. I don't think we've had, Intel's after the close. So we have had some bits in here. I don't think any of these are really going to have a big impact on the actual Broader indices, but they're all mostly green, as you can see in here. Probably Intel's the biggest thing we should probably be watching after the close in here, again, to see the strength of the tech sector, to see the strength of the semiconductor industry, the chip industry in here. That is after the close, though, this evening, the from Intel. So we're watching out for that later. I'm just trying to run through in here what I've kind of missed. I don't think there's too much in here. Dollar, we've covered. Global stocks saw really just 5 things, but I think I'm going to have covered everything in here anyway. So Fed hike, so quarter of a point up. We know that, seeing they will be data dependent. Meta rallied in here. We've already covered Meta. Chinese investors, hedge fund clients bought Chinese stocks. So not only is the hopes for the stimulus coming, not only is the tech doing particularly well in here, but also hedge fund clients, big buyers of stocks in here. And stocks are up, basically just saying stocks are up. And this is what we've got coming up today, which we've already covered in here. What else are in here for you? ECB, we're covered in ECB, we're covered China, ECB and Meta. So just a note in here, Treasury yields may fall 150 basis points next year. This is from Jupiter. Okay, so Jupiter, the fund manager, is saying that they are looking for a significant move down in Treasury yields. Okay, likely as we go into a rate cutting. Of rate cuts expected, pivoting away from rate cuts. But at the moment, this was really noticeable in here. This is 10-year yields yesterday, hardly moves. Look, not much of a move yesterday. This morning, slightly down, slightly back up. So 10-year yields not really moving after the Fed in here, and that's kind of was echoing what we saw in the Fed tool in here. Not really much change in the Fed tool, not much change in yields. I wouldn't be surprised though if we start to see yields move significantly lower over the coming weeks. We are going obviously into maybe the summer doldrums, but I wouldn't be surprised to see a grind lower. I don't think it's going to be an acceleration. I think we might see a grind lower in yields as we go through the summer. A very quick look at the charts, but very little to say in here. We've had this, super strong rally in the S&P in here to new highs, but really driven by that strong rebound in here from the Nasdaq, taking out the highs from the last couple of days, really looking strong in here. I mean, we're right on the highs right now. I can't be anything more than bullish in here as we go into today. The only concern I have is we've moved a long way already. Obviously, the Nasdaq's already up best part of 1.5% or whatever it is. We've already had a big move. The S&P's still got room to move further. We are making new highs, multi-month highs in here, but I do think there's still upside potential there. Let's have a quick nod to the elsewhere. So dollar is down, as we said. Look, it's fading down in here, the dollar in here. Significant moves lower, as we move out of risk off, more into risk on. Gold on the back of that popping back higher. Okay, so gold retains this underlying bullishness from this kind of basing pattern that we've had going on in here over the last month. So gold pointing up, dollar pointing down. And if we go take a look at oil in here, first of all, on the daily, kind of sideways in here, but for me, there's an underlying resilience for oil, and I wouldn't be surprised to see oil go and test the high from earlier this week. So this is the September contract, that high at 79.90. Popping through there, and maybe this kind of psychological 80 barrier, maybe up towards the highs up here, 81.44. So maybe not today, but over the next 24 hours, I think oil could easily move to that kind of region there on the September contract. Okay, any questions from anyone? Glad you guys have been asking some questions today. Really like that. Thank you very much for that. Any further questions? I'll just wait another minute because I know it takes a little while to type in. And I know there's a bit of quite a delay actually. Surprising how big the delay is on me asking, are there any questions to you guys actually hearing it and then answering? No, nothing coming through. All right, guys, I'm going to wrap it up there. Yes, thank you. We will revert with Ninja Trader 8. Apologies again, but there's not much we can do. We are as frustrated as you guys are, but we'll give you some update hopefully in the forums tomorrow. It won't be on tomorrow's webinar. We're not having the meeting till later than this tomorrow, but then we'll let you know. And if we get anything between now and then, we'll also let you know. All right, guys, have a great trading day. Take care. Stay safe. Bye.